We're talking about Samchem Holdings, Berhad. They're a chemical distribution company on Bursa, Malaysia. Now, at first glance, their Q1 earnings report looks like an absolute home run. I mean, we've got this massive headline profit number that is practically guaranteed to induce instant FOMO for any retail investor watching the market. But if you look just a little closer, there's a really bizarre twist here. Their revenue actually dropped.
Just take a look at this staggering number, a 252% profit jump. And no, that's not a typo. Profits literally went up by 252%. In the investing world, when you see a number like that pop up on your screen, your eyes naturally widen, right? It screams momentum, it screams growth, it completely hooks the market's attention. But as focused learners, we don't just stop at the headline. We've got to understand the mechanics actually driving it.
And that brings us to the ultimate forensic mystery of this explainer. How exactly did Samchem's profits basically triple when their revenue actually went down by 7% year over year? It's a total paradox. I mean, usually massive profit growth is fueled by selling a whole lot more product, right? But here, they sold less and yet made infinitely more money. So what's going on? Is this some brilliant structural transformation by the management team, or is there something hiding beneath the surface of the accounting?
Section 1. The Q1 Earnings Paradox, Peeling the Onion.
To figure out the source of these incredible numbers, we're going straight to the official earnings report. Look right there at the profit before tax line. The group recorded a massive jump to RM 18.3 million for the current quarter, and that's compared to just under 5.9 million in the preceding quarter. So the profits are absolutely real on paper. This completely validates the bullish momentum you might be seeing in the stock right now. They really did record this windfall. But the why? Well, that is where things get really fascinating.
Section 2. The Geopolitical Margin Illusion, Straits of Hormuz.
When we dig into the equity research, we start to see that this isn't exactly a stroke of day-to-day operational genius. It's actually more of an inventory timing arbitrage driven by global geopolitics. Let's use a super simple analogy here. Imagine Samchem buys a drum of chemical for 100 ringgit and sells it for 110. Their gross margin is 10%. Now that 10% is their historical average, and it has to cover all the bills, salaries, rent, loans, the whole shebang. Well, in Q4 2025, they bought some low-cost inventory, and their margin crept up a bit to 12.6%. But look at Q1 2026. That margin absolutely exploded to 16.6%. Because their revenue fell 7%, we know for a fact they didn't sell more volume. The entire profit explosion came from this massive unit margin expansion, which just heavily padded their bottom line.
So, the absolute crucial point here is understanding what caused that margin spike. And luckily, we don't have to guess, because management tells us directly. Notice their exact phrasing here. They say disruptions of flow through the Straits of Hormuz led to tighter supply and an overall increase in chemical selling prices. This is just a purely neutral observation of global trade flows. Basically, Samchem accumulated inventory at depressed prices in late 2025, and then global supply chain tensions pushed selling prices way up. They sold their cheap inventory at these new elevated prices. Boom, windfall. But here is the huge risk. They are now purchasing new inventory at those elevated prices. If geopolitical tensions ease up and prices normalize, those inflated margins, they could disappear just as fast as they arrived.
Section 3. The Missing 46 Million Cash, a Forensic Warning.
Okay, you've got to look at this stark visual contrast, which analysts are calling the most alarming red flag in the entire report. Samchem reported a profit after tax of roughly RM 14.8 million. Great, right? But check out their operating cash flow. It's negative RM $46 million. Guys, that is a staggering $60.8 million divergence between the profit they reported to shareholders and the actual cash generated by their operations.
Let's jump over to the actual equity research analysis and see how this builds. Insight number 1 clearly states the profit is real, but the cash isn't. Well, at least not yet. And this isn't just some bearish opinion. It is a documented forensic finding. Seeing a cash conversion ratio this negative is definitely unusual. What it tells us is that Samchem is running a really aggressive inventory accumulation strategy. They're basically betting that margins will stay high long enough to sell off all this expensive stock. If they're right, their cash flow in the next few quarters is going to be fantastic. But if they're wrong and prices drop, they are stuck holding some incredibly expensive inventory.
Section 4. The Dividend and Debt Squeeze, Borrowed Payouts.
This whole cash flow issue brings us right to the psychology of the market, and honestly, the main reason retail investors continue to hold this stock: the dividend. Shareholders love to get paid, right? The company declared an interim dividend of 0.8 cents per share for the quarter, but we really have to put our critical thinking caps on here. If the company just generated negative $46 million in operating cash flow, where is the cash for this 0.8 cent dividend actually coming from? If the day-to-day operations aren't producing the cash, that dividend is essentially being paid out with borrowed money.
And that is exactly where the shadow risk really hammers home. Total debt has now reached $216 million. That's the highest we've seen. Analysts point out that when you factor in corporate guarantees, which is essentially promising to cover someone else's debt, the true economic leverage is pushed to an estimated 1.42 times. That's way higher than the 0.67 times stated on the balance sheet. And remember, most of this is trade-related debt. That means it relies entirely on customers paying Samchem on time. If those customers start paying slowly, Samchem faces a major liquidity squeeze.
Section 5. Bull versus Bear Showdown. The Future Outlook.
So we essentially have two very different realities coexisting in one financial report. Let's step into the ring for a second and look at the debate. If you are a bull right now, you are pounding the table about a structural shift. You're pointing out that operations in Vietnam are showing a real, solid turnaround. Plus, the company is investing $29 million in a new storage terminal. They're shifting from a pure trading business to a more integrated distribution and logistics player, which, historically, attracts much higher market valuations. But if you are a bear, you are pushing back hard. You're arguing that Q1 was just a peak cycle fluke. You're terrified that margins are about to compress, and you're really worried that chemical producers in China are going to resume dumping excess supply into Southeast Asia. That would absolutely crush those beautiful margins while the company is sitting on a mountain of high debt.
To synthesize all of that, here are the 4 critical risks that every retail investor needs to literally screenshot and deeply understand before making a move. Number 1, margin compression. If supply normalizes, profits could easily drop right back to $5 or $6 million per quarter. Number 2, China dumping. If that oversupply pressure returns, margins get squeezed incredibly tight. Number 3, borrowings. That $216 million debt pile relies entirely on fast customer payments. And finally, number 4, currency. A weakening Vietnamese dong could quickly shrink those impressive Vietnam turnaround numbers the second they're converted back into ringgit.
Section 6. The Q2 Verdict. What to watch next. Now, none of these risks mean you should just ignore the stock. Not at all. It just means you need a really clear, actionable framework for what to watch when the next set of results drops. And here is the magic number you need to remember: 14%. Analysts agree that 14% is the gross margin line to watch in Q2. If gross margin stays above 14%, the bull case is highly intact, and it means Q1 was genuinely the start of a sustained earnings upgrade. But if it drops below 13%, you need to start asking much harder questions about management's credibility. And alongside this, you absolutely must look for a recovery in operating cash flow. We need to see that negative $46 million flip into positive territory, proving without a doubt that these profits are actually converting into cold, hard cash.
So I'm going to leave you with this final thought for today's explainer. Is management truly transforming Samchem into a logistics and distribution empire that warrants a much higher valuation? Or did they just surf a very lucky, very temporary geopolitical wave? The upcoming Q2 numbers will reveal the truth. Keep your eyes on those margins and that cash flow. Thanks so much for joining me.